Aloha, everyone. Is stock picking dead? Can Warren Buffett style investing still work in a world dominated by AI algorithms and nonstop market noise? Welcome to Inspired Money. I'm advisor Andy. Today we're diving into a big question, for me at least, of 2026. Do timeless value investing principles still give investors an edge, or has the game fundamentally changed? I love this Warren Buffett quote. When we own positions in outstanding businesses with outstanding managements, our favorite holding period is forever. I've seen this firsthand. I've seen tremendous wealth built through ownership of great businesses, durable earning streams, disciplined management teams, and long-term compounding over decades. But markets do feel different today. Everything moves faster. Bear markets can collapse and recover in months instead of years. Trading volume is increasingly dominated by algorithms and machines rather than human investors. And it reminds me of 1992, when I interned at the New York Stock Exchange for a summer. At the time, the floor was packed with people shouting orders, making markets face-to-face. There were a lot of paper tickets. Today, much of that world has become electronic, part trading venue, part television studio, part financial media stage. So I think it is a real question. Have the rules of investing changed, or just the speed of the game? So in part one of this program, we'll explore intrinsic value, margin of safety, economic moats, and why disciplined investing matters in speculative markets. In part two, we'll tackle AI-driven markets, investor psychology, contrarian investing, market bubbles, and whether human judgment still matters in a world flooded with information. And then stay with us to the end, because in part three, Barry Ritholtz joins us for a one-on-one conversation about his book, How Not to Invest. And we'll talk about the biggest mistakes investors continue to make in modern markets. Thank you for being here. Drop a comment to tell us where you are geographically. And do you consider yourself a value investor, a growth investor, or maybe a little bit of both? This is going to be a smart, practical, and timely conversation designed to help you think more clearly about investing, about risk, and about long-term wealth creation. But first, a word from our sponsor. This episode is brought to you by Seeking Alpha. If you're a self-directed investor looking for deeper research, actionable insights, and analysis that goes beyond the headlines, check out Seeking Alpha Premium. One thing that I like is that Seeking Alpha, it combines professional analysis, quant-powered ratings, and investor perspectives all in one place. It helps investors make more informed decisions instead of chasing hype and speculation. And Seeking Alpha is about to run one of its biggest sales of the year. From June 10th through July 7th, Premium is just $225 per year. That's $74 off. You can get Alpha Picks for $375. That's a savings of $124. And the Premium Alpha Picks bundle is discounted by $173. You can learn more and take advantage of the summer sale by going to inspiredmoney.fm/alpha. That's ALPHA, inspiredmoney.fm/alpha. All right, let's bring in our panel. Phil Town is a hedge fund manager and New York Times bestselling author of Rule Number One, known for teaching millions of investors how to apply Warren Buffett-style value investing principles to real-world stock analysis. We have Brian Feroldi back on Inspired Money. He's a bestselling author, former Motley Fool writer, and financial educator focused on helping everyday investors understand long-term investing and business quality. And he puts it in plain English. And rounding out our panel today, we have Victor Ricciardi. He's a leading behavioral finance researcher, a professor whose work explores investor psychology, risk perception, and the emotional drivers behind financial decision-making. Gentlemen, welcome to Inspired Money.
Morning, Andy.
Yep, great to be here, Andy.
Morning.
You guys are pros. Nobody spoke at the same time. Excited to have you all here. Let's begin and jump right into segment one.
Look at the market noise. Everyone is chasing price. but we are chasing intrinsic value. Value investing is an investment paradigm where we buy securities that are underpriced based on fundamental analysis. It's the art of finding a gap between market price and actual worth. This isn't just a strategy, it's a rigorous operational discipline. As Warren Buffett handed the reins to Greg Abel this year, he reminded us that while people change, the principle of buying a dollar for 50 cents never does.
Phil, you've taught millions to think like business owners instead of traders. Was there a company that permanently changed how you define value?
I don't think there was a specific company so much. I started my career with kind of private equity early on, and it was very early in the game when I started to realize that there can be a huge gap between the intrinsic value of a business and the actual price of a thing. And of course, it all boils down to how we're defining intrinsic value, right, Andy? It's like, how do you figure out what this thing is really worth compared to what the market thinks it's worth? And that's been a challenge my entire career. And the way we deal with it, the way I deal with it and have dealt with it for 40 years is to make sure I'm not getting into a state of hubris and confirmation bias about the work I'm doing, the research I'm getting into, so that I don't get caught up in a kind of a belief system and try to stay skeptical, and I try to stay focused on things I really understand. And I don't think much has changed in 40 years about that. It's like my understanding of things has gotten a little broader, but after 40 years of this, you start to collect some ideas about certain industries. But yeah, I just find that intrinsic value is the thing that you can figure out when you really understand a business and when you really get it, and when it really has a big moat that you can understand is going to be around for a long time. And short of those two things, figuring out intrinsic value is really, really difficult.
Encouraging to hear that intrinsic value still matters. Brian, how do you explain intrinsic value, especially to a generation of investors raised on momentum trading and meme stocks?
It's a very difficult thing to do. People want to talk about the stock that has gone up the most in the last month, year to date, or even the last 3 years if they're truly thinking long term. But teaching the concept of intrinsic value, that this business has a value and that business should be attempted to be bought at or below that value, is a really difficult thing to do. So I try and focus my energy on explaining what the fundamentals of a company are, how the fundamentals of the company relate to what the business value should be or approximately should be, how the business value relates to the price that you see by teaching basic concepts like market cap. And then I think that Warren Buffett has done everybody a favor by making the concept of margin of safety widely known and widely available. But the hard find that I find is attaching the fundamentals of the business to what people see every day, which is a moving stock price. If you can do that, then understanding intrinsic value margin of safety becomes much more obvious.
Victor, decode this a little bit for us. Do investors actually want rationality, or do they secretly want excitement?
I think we're primed to want excitement. I think we're primed also to invest in growth stocks. The thing is, when I'm teaching, so I've been teaching long enough where I remember the internet bubble of the late 1990s, and all my students said, Professor Ricciardi, you're crazy. You're teaching us about stock valuation models, and these no longer apply. Well, when the bubble burst, it was amazing. Warren Buffett and high-quality dividend-paying stocks and value stocks were back in style. So it's trying to get people, if rationality is going to apply, is educating them, talking about the history of the market, and then thinking within a diversified portfolio and understanding that just like the economy grows in cycles, growth and value stocks grow in cycles as well. So that's why I always make the point, even my own personal investments, is to hold both. I can't predict the future. I can't beat the market, so I own both.
Phil, when you look at today's market, where do you still find true intrinsic value hiding in plain sight?
I think the market is actually starting to really turn toward value as a larger and larger percentage of the market is wrapped up in AI type stocks. And as a result, we are starting to see some things open up. It's definitely outside the AI field and in areas where companies are really under threat from the advent of artificial intelligence. I'm thinking particularly in the SaaS companies, software as a service. There are companies in there that are going to be destroyed by AI, no question. But we have found some really big values in businesses that are not, they're going to benefit from AI rather than being destroyed by it. So as AI sucks up more and more of the air in the market, I think you're going to start seeing more and more companies go on sale. Even just your basic restaurants are starting to get to a point where, it's like very, very, very interesting because there's only so much money out there. And the more it flows into the AI part of the market, it's got to come from someplace. And those places are where value of investors have been finding value for 100 years.
Brian, is there a simple metric that quickly tells you a business may be misunderstood by the market?
No, there's no single metric that tells you anything about any company. This is a major mistake that I find that most investors make. They learn about a simple metric, especially price to earnings, and they apply it uniformly to all companies at all times. I think that's a huge mistake. Valuation metrics are highly useful, but you have to know what phase of the business growth cycle a company is in so you can figure out what is the best way to value that company. As an example, take a company like Rivian. Rivian is not profitable, has not been profitable for a long time. If you think that using the PE ratio to value Rivian is the way to tell if it's cheap or expensive, well, you're going to get negative infinity. So that's going to be utterly useless to you. If you go on the other side of the business quality or business phase, if you go down that, take a company like Microsoft or Apple or Google. These are highly profitable companies, wide moat, with durable, dependable earnings. So these companies are fully optimized, at least partially, for earnings. Therefore, the price to earnings ratio, the PE ratio, is useful for judging the valuation of those companies. So there's no single metric that you should look at to determine whether a company is cheap or expensive. You have to take it on a company by company basis.
It's interesting that you bring up the EV example because I approached the thinking in reverse. Because I was looking at some of the EV companies and I said, these companies are losing a lot of money. So I don't want to invest in this company. But as a consumer, maybe I'm getting a higher quality car because they're losing money. I'm getting a good deal. Plus, some of the government incentives when they were still there, I was saying, I could get a rebate. Plus, the company is giving me a higher value car because they're building it at a loss. I did not pull the trigger on that. But the thinking was there. The rationale was there. Victor, do you think that technology is making markets more efficient or just faster?
I think I would say yes to agree to both. Again, technology is helpful, but like anything else, if you overuse it, but also behaviorally, what people don't think about, if you're at the market level, I think it's creating that efficiency. The problem, though, is on the individual level. There's a study, for example, that showed by Brad Barber and Terence Nadine, even when going back in the 1980s, that showed when people switching the trading mode from the phone to the internet, well, the accessibility of trading and technology on the individual level accounted for some retail investors actually trading more because they were able to do it online. And that indirectly increased their overconfidence. So, like everything else, technology has its pluses, but it also has its minuses as well. But also, that efficiency is trying to get people to think over the long term. And that's why when you're talking about intrinsic value, it is really a long-term concept. So trying the connection to getting people to think about intrinsic value is also trying to get them to think rationally as well.
Intrinsic value, long-term, and it does require patience. Brian mentioned margin of safety. So let's roll segment 2.
In 2026, the gambling mood has taken over, but the value investor relies on the margin of safety. This is the Benjamin Graham principle of buying with enough of a discount that even if you're slightly wrong about the future, your capital is protected. Think of Mr. Market, that moody character who offers you different prices every day. We don't take his lead. We use his mood swings to our advantage, staying patient while Berkshire builds a record $397 billion war chest to deploy when the gambling stops.
Brian, how should younger investors think about margin of safety in high growth companies?
Well, there's lots of ways to think through what margin of safety means. The classic definition is buying a stock below its intrinsic value. That's one way. Another way of building a margin of safety is by controlling your time horizon. If you buy a stock that's growing very rapidly and you think that company has long-term upside, especially when focusing on where the market cap is today and where the market cap could be in time, you might not need a margin of safety, a quote unquote margin of safety to make money on that investment. Amazon, for example, hasn't looked cheap at all. Or rarely has looked cheap over the last 20 years. If you bought the stock in any year over the last 20 years and held into today, you've done phenomenally well. So in that way, the margin of safety that you got was by buying and holding and allowing the company to grow its intrinsic value and its market value by simply executing the market plan that it had. That's one way of going for a margin of safety, and that's the method that I prefer. Another one is just looking for stocks that are trading below their intrinsic value, buying them, and then hoping that you can sell them when they get to their intrinsic value. There's multiple ways to invest. No way is right or wrong. There's just the right or wrong way for you.
Phil, what are your thoughts? And Warren Buffett's sitting on huge cash reserves. Patience or a warning sign here?
Yeah, well, I think it's a warning sign if you think that the markets are going to go up forever, that the best investor in the world is handed over, almost $400 billion to Greg Abel. I think that's a big warning sign. I think Warren has been extremely aware over the time of his career about when to be in cash. And I would be really nervous now if I was sitting completely invested in the market and the best investor in the world is camped out on that much money, because I think the worm always turns. As Vic said, it's just a matter of time before the market seeks value, and I think that time is coming on us. It's been a long time that the governments have been pushing a tremendous amount of cash out into the economy, and that cash doesn't have anywhere to go except into the market predominantly, and has been driving things up. And when that cash hoard stops flowing, you're going to see a reset on a lot of values. So I think it's both an opportunity, Andy. I think it's a tremendous opportunity. We're sitting predominantly in cash now, which by that I mean we're in bonds, and we are just waiting patiently. We have some exceptions, but basically we're waiting patiently for this market to do what it's always done, which is to turn around, drop down far below where people think it should go. And when that happens, man, so many great companies are on sale. So right now, what we're focused on is just making sure that our wish list of wonderful companies is really, really solid. We know the order in which we want to buy things if this market crumbles. And I've been around this 40 years, so I'm quite confident that day is coming.
So it sounds like you've got your playbook and your strategy and you're waiting.
Yeah, exactly. We're quite comfortable that the way the market functions is predominantly driven by institutional fund managers who receive their money not so much from individual investors, but from big other institutional fund managers. So, for example, the California Teachers Fund is putting $180 billion into the market. They're going to spread that around, and if they hand some of that to me and say, "Here's $200 million," I have to be really nervous that I need to get that money into the market right now. I can't be patient and wait around like Buffett's been doing for 2 years, waiting for something to go on sale. I have to move it now. I got to get it into the market because the pension fund manager that gave me the 200 million is perfectly capable of being in cash by himself. And this is a fundamental of the market that isn't recognized by many people when they're looking at how the market functions, but it is absolutely fundamental to the way the market functions. And when you realize that, then you start to realize that the only edge that I really have and that you have as a value investor is to be really patient and wait for that opportunity where the problem in the market is going to be not short term, it's going to be longer term. And when that happens, then these guys are going to get out. They have to.
Victor, behaviorally, how do we avoid the temptation to follow Mr. Market and instead exploit him?
I think to get overtaken by the noise of the market. And that's, as I said, being a long-term investor is very difficult. It's not easy. And understanding that history and also setting goals. I mean, a lot of this is also people are taught on the rational side to maximize utility. Well, or the value of the portfolio. There are many other ways to look at it. So whether you're looking at having a financial goal for retirement, what is your money for? The I in, if you want $2 million for retirement, your I in your portfolio is your personal I. You're not looking at the returns of the S&P 500. So teaching people just how to benchmark and understand whether they're going towards their financial goals. But also don't follow the herd. This has all happened in the past. There have been plenty of bubbles. People blow themselves up. And unfortunately, what happens is they don't get to the market. So when the market is going down, they should actually view that as a buying opportunity. We're primed. When greed is good, we tend to buy and overpay for stocks. Well, when on fear, when the market is going down, is actually when we should be buying those value-laden stocks that have true value. And many of us, because we're human beings, cannot pull the trigger. It's happened to myself. The research by Vernon Smith actually took me, it's the same, takes about 3 bubbles to actually learn how to invest in a bubble. Because the first time you blow yourself up in the bubble, you have the pain of losing that money. The second time, you recognize the bubble, and then maybe you can't pull the trigger. And maybe the third time around, I say, oh, I have a disciplined strategy in place. I'm doing dollar cost averaging, and I'm buying low and I'm getting more shares of higher quality companies at a discounted price.
It's better late than never, Victor.
Yes.
And experience matters. So shout out to Bill from Catching Up Fi. Let's go to segment 3.
We have to look beyond the spreadsheet to the qualitative moat. Intrinsic value is fueled by a company's sustainable competitive advantage, its brand strength, management quality, and cultural alignment. This is the miracle we look for. If you don't understand why a company has a moat, you're just chasing numbers. We are here to bridge the gap between corporate stories and financial data, turning narrative into a predictable engine for wealth.
Phil, what are the early warning signs that a moat may be starting to erode?
Well, there's a couple of them. One is what the management team is doing with your money, the equity that you've got in the company. We watch return on invested capital, return on assets, return on equity, but particularly return on invested capital, because when a moat is starting to be eroded, what management teams do is try to protect themselves, and they do that by going out and acquiring other companies rather than pushing money back to the shareholders. And that, if they're not doing a good job of that, they typically are starting to erode their return on capital, and that number starts to go down. And that's a big red flag for us. We also, of course, are watching the major numbers. We're looking at earnings. We're looking at margins. And when we start to see earnings, margins, and particularly cash flow start to erode, then we know that something is going on out there. And it's okay if it's going on for a year and we understand it. But when we're looking at that bad year and seeing that we don't understand what's going on, why is Lululemon why are their numbers suddenly turning around and going bad? And management teams telling you a story. And by the way, they always tell you a story. They always have some reason that is not what the real reason is, usually, because they're defending their own turf. But when you get a company like Lululemon and it starts to go down, you really got to understand, did their moat just get broken? Did they lose their technological edge, which is what their founder says happened? Or are they just what management says, oh, we got a problem with tariffs? Or you look over at a company like a Chipotle, which gets into E. coli poisoning in their restaurants, and you ask, okay, well, is the moat broken? Do people no longer want to go to a natural, organic kind of really high quality fast food because of E. coli? And we look at that and go like, okay, well, that's going to get fixed and the moat isn't broken. So I don't know how in the world you would understand the moat of a business unless you really understood the business really, really well, if that's not redundant. And I don't know how you get to a margin of safety without understanding the moat, because you can't figure out what the cash flow is going to be like down the road. So moat is just super critical, and understanding that it's broken or not broken is fundamental to what I do, because I want to buy stuff on sale. And when they go on sale, there's always a reason. Ideally, it's just some big recession, but generally speaking, there's a problem going on there. And it's a big enough problem that the market, like Mr. Market in Wall Street, is bailing out like crazy. They think the theater's on fire and they're going to get out of there. And my job is to understand when they're right and that there's a long-term terminal problem in this company, and when they're wrong, when the problem is just something that's going to get fixed in 2 or 3 years. And that's just critical.
Victor, why do investors become emotionally attached to great brands even when the fundamentals are deteriorating?
Well, and I think you had mentioned a little bit earlier in our conversation, the idea is just because you're a consumer of a company doesn't necessarily make it a good investment. The same idea is if it's a good company isn't necessarily a good investment. It's okay, you use that as a filter, as a qualitative piece, but then you have to verify with the fundamentals, does it meet the criteria that you're utilizing to evaluate as part of investment philosophy? But like anything else, I can remember, whether it's the internet bubble, people fall in love with brands. I mean, I remember especially that's so real time to me, even in the late 1990s, people were having parties, Dell parties, because they were buying Dell stock. And so that's where, the social group, and people fall, and also people want to be part of the crowd. I remember also, when my mechanic is telling me to buy internet stocks, that's those qualitative pieces, as this segment talked about. There's observational pieces when and then currently when I'm getting last couple of years or so, getting Facebook on Facebook or social media telling me to buy crypto or to buy all types of different types of AI stocks, is when you have to observationally look, maybe the bubble, you are not necessarily at a bubble, but these are times to make sure you are diversified, not getting out of an asset class, but making sure you have enough diversification where that asset class is, in terms of myself, maybe 3 to 5% of your overall portfolio. So get it to actually apply the rules of portfolio management with a value strategy and a growth strategy is just something that people who are invested find it extremely difficult to do.
Brian, elaborate on your reference to no AI and whether you have a moat or no moat.
Oh, that was in regards to a question about why Berkshire Hathaway has dramatically underperformed the market over the last year. The viewer pointed out that Berkshire Hathaway stock is down like 30% when compared to the market. It's down 4%. The market's up 28%. And the viewer is asking, well, why is that happening? I think there's a number of factors that are going against the company right now. There's certainly, obviously, the greatest CEO / investor of all time, Warren Buffett, handing the reins off to Greg Abel. There's the massive cash position, and then there's the extremely limited "quote unquote" AI exposure that Berkshire Hathaway has. You might say that it has some backhanded exposure with some of its subsidiaries, perhaps with its utilities business has some indirect exposure to it. But I would say that all of those factors together, when combined with its no AI exposure, have caused the stock to underperform.
No AI exposure is a major one. I was just looking across client accounts yesterday, and if you did not own semiconductors or you didn't have, direct AI exposure, your portfolio performance looks very different compared to the S&P 500. As a value investor, Brian, how are you approaching looking at a group of companies, whether AI or no AI right now?
It's definitely an extra risk that you have to think about when I'm thinking through, is this company a fit for my investing style? Historically, I've shied away from many of the companies that have been on fire this year. They've been memory companies. They've been semiconductor companies, which historically have been highly cyclical with their revenue and their profitabilities. And I have no ability to predict those cycles with any degree of accuracy. So I have just personally sworn off those entire sectors as uninvestable just for my investing style. Now, that has proven to be a reason for underperformance over the last over the course of 2026. But I'm perfectly fine with that. Markets are very fashionable. Every now and then, some stocks or some sectors are in fashion, others are out of fashion. I have no problem being out of what's fashionable. I like to focus on durable, high quality growers that I can buy and hold for long periods of time. That's my investing style, and I think that as long as I stick to that style, I'll be very happy over the long term.
I am not stylish, so I will wait for the wide ties to come back in fashion. Nobody's wearing a tie, so I may be waiting for a very long time. I think that one thing that stands out to me in this discussion of value investing is that value investing is not disappearing. It may actually be becoming more important as markets become faster, noisier, and more emotional. If you're just joining us, you're watching Inspired Money. I'm your host, Andy Wong. Now, in part 2 of our show, we're going to push this conversation even further because today everybody has access to much of the same information. They have AI tools, they have the same headlines. So if information is now a commodity, where does the investing edge come from? We're going to explore contrarian psychology, market fear, AI-driven investing, and why human judgment may actually become more valuable in an increasingly automated world. And perhaps most importantly, can rational long-term investors still outperform in markets increasingly driven by speed, speculation, and emotion? And then stay with us at the end of the show. We'll have part 3. Barry Ritholtz will join us to discuss his book, How Not to Invest. Let's continue the conversation and roll segment 1.
Buffett says the most likely time to buy is when everyone else stops answering the phone. That is contrarian psychology in action. The Strait of Hormuz remains contested, yet markets sit at all-time highs. That's complacency. When the herd finally panics, and it always does, the value investor is ready. We aren't reacting to the headlines. We are reacting to the fear inside the headlines.
Victor, you pointed to, making the same mistakes in a bubble. It takes the experience. You need to earn that experience and make those mistakes so that the second time, the third time, you're getting better. How can we train ourselves to access our logical mind when we're fearful and scared?
Well, that's what the idea of having a financial plan in place that even myself, I know I tend to be a worrier. I tend to be overconfident. I even tell my students, I blew myself up in the internet bubble in 1990. So I became a believer in behavioral finance because I realized I wasn't rational. And so having that, it sounds very boring, having that rational, diversified portfolio of mutual funds, ETFs, across growth and value, why you're investing that money, dollar cost averaging. And I also, the one thing that I especially look for in value companies is I love cash flow. So sometimes the boring stocks, to me, are the fun stocks. So, and then the way I described to my students is, thinking about your risk tolerance. You look at high beta stocks and low beta stocks. To me, so the high beta stocks I call rabbits, the lower beta stocks I call turtles. Well, you want to have some turtles if you're a turtle-related conservative investor, but you also want to have some rabbits. And if you're a rabbit investor and you love aggressive risk-taking growth stocks, you should still have the turtle-related stocks just to have that diversified portfolio, and that helps you avoid those bubbles, but also it helps you reduce and remove that emotional aspects of markets, whether they're going up or down. And again, when the markets are going down, if you're a long-term investor, view it as a buying opportunity.
So I'm hearing diversification between rabbits and the tortoise and having systems. Phil, when markets panic, what keeps you calm enough to buy?
Yeah, I'm thinking, just thinking about what Vic has just said about diversification as a way to stay calm. What I want to do is I want to have a rabbit portfolio with a turtle mentality, if I can think about it like that. I want to have really safe businesses, but I want them to go up at 26% a year, right? That would be the ideal thing. And it's funny when you talk to a financial advisor, they never ask you that question. Do you want a really high return with very low risk? And that to me is the essence of value investing, is the potential for very high returns at very low risk. But in order to get that, you have to be willing to stay in cash for long periods of time when the market's going up like crazy, and just way underperform the markets. You have to be a contrarian. You have to, if you're going to stay into a great company for the long term, you have to be willing to watch that thing go down by 50% and still feel comfortable about it. So if you're comparing yourself to the overall market rate of return, I think you're making a mistake if you're trying to be a turtle that gets rabbit returns. You have to do something very different than that. And what I think you have to do is wait patiently for the market to do what it always does, and that is overprice something so significantly, or some industry group so significantly that eventually even Wall Street thinks it's stupid to buy the thing at this price. And when they start getting out, it's like a herd trying to get out of a crowded theater where they're smelling smoke, and it just becomes a chaotic exit. And that's when you can step in and buy. So I think I'm a little different point of view as a manager. I don't like diversification. I think diversification is, as Warren said, it's for the ignorant, which I think it's a little bit tongue in cheek, because most people are not well-informed investors and are not going to be able to be good at picking out companies unless they really put the work into it. And I think Warren would agree and say you should probably be in the S&P 500 index and call it a day. But otherwise, I don't think diversification is going to get you to those rabbit returns with safety. I think in order to get those big returns, if you don't follow value investing principles, you're going to be buying into, like, say, AI right now at really high prices that are reflecting just perfection out in the market well into the future. Everything's going to be rosy, and if it isn't, you're buying a really high priced entity, and you might not be able to get your money back for a long time. I just prefer to do it a different way, and I like the value investing style. I think it's relatively low risk with relatively high returns if you do it right.
Brian, it sounds like you've developed your ability to be patient, your ability to avoid fear of missing out. What historical perspective helps you and investors to survive the scary headlines?
Well, I think it's part just your natural temperament, but the thing that has helped me is experience living through headline after headline that looks horrible and seeing how the market eventually recovers and returns to its historic growth rates. But more importantly, is just like Vic said, the most important thing that I think investors can do is study market history. Everything feels unprecedented when you are ignorant of what has happened in the past. Everything that's been thrown at me as an investor over the last 25 years that I've been investing, we've seen that movie in some flavor play out before. I mean, during the Great Depression, the stock market peak to trough fell, I believe, 89%. I mean, I can only imagine what that was like to live through as an investor. It makes the 60% loss that I experienced in 2008 look like a walk in the park by comparison. But there's no amount of thinking ahead of time that you can do to prepare yourself for living through a market downturn. It's so easy to say I'll be rational when everyone else is fearful. It's an entirely different thing to live through it minute by minute, day by day, when you're just seeing a sea of red.
We have the gray hair or the lack of hair to to prove it. Let's move on to segment 2.
Intelligence is now a commodity. Everyone has the same data, the same AI tools, the same analysis. The edge in 2026 isn't information. It's recognizing the gap between what everyone believes and what's actually true. We look for the human intent premium, the judgment, conviction, and insight that AI can't scrape. And we find value on the infrastructure frontier, the picks and shovels like energy and data centers that power the AI revolution.
Phil, if everybody has access to the same information, the same AI tools, where do you think the edge comes from?
Well, I think first off, everybody having access to all of the information is a phenomenal opportunity for the individual investor. It basically democratizes the information and allows an individual investor to function in a really even playing field with Wall Street. And when that happens, individual investors have such an advantage over a Wall Street fund manager. It's a shame that we all don't take advantage of that, because those Wall Street managers, as I said earlier, they have to perform on a quarter by quarter basis. If I'm a pension fund manager handing my money to a hedge fund manager, that person can't sit in cash and wait, but an individual investor can. And having the information available so that they know as much as the Wall Street manager does about any company, and they understand that there is a different set of incentives between an individual investor and a Wall Street fund manager, that fund manager has to perform on a quarterly basis. The individual investor just has to get to retirement wealthy. And so you got a lot of time where you can let things happen, where companies can go through some problem and come out the other side in a sort of obvious kind of way, like Chipotle with E. coli. It's really obvious what's going on there and that they'll recover. And yet Wall Street bailed on that company and ran away from it because the cure was going to take a couple of years or 3 years. And when that happens, you no longer have this asymmetry of information. You know as much about Chipotle as anybody on Wall Street, but they're operating on a different time frame, and that's the edge. You don't have to have the genius edge. You don't have to have more information edge. What you have to have is the patience edge, and you have that as an individual investor. So you should use that, and that's the thing that's going to get you really good companies at really safe prices. I think is just be patient.
Brian, what's one thing human investors still do better than machines?
Well, machines don't have the same goal in mind that you as a human do. Phil just pointed out something really important. Individual investors are not money managers. Money managers have handcuffs on them in so many ways that prevents them from thinking and acting with a long-term mindset. You have none of those handcuffs as an individual investor. You're not responsible for reporting your results to other people every 90 days. You don't have to compare yourself to the S&P 500. The only thing you should compare yourself to is your financial goal. That's really the only benchmark that matters. Can I reach my financial number to achieve the lifestyle that I want in the time frame that I want it to? That is such a massive advantage that individual investors have, and you give it up if you act inappropriately with the market, if you behave in the wrong way, if you follow stocks on the way up and avoid them on the way down, if you do all the things that are naturally built into you as a human, you will be a bad investor. Phil is 100% right. It all comes down to psychology and having a long-term differentiated mindset than most of Wall Street. That's your only edge as an individual.
Keep your eye on the prize. Victor, do you think that outsourcing decision-making to algorithms, does that dull our decision-making skill?
I still have a skepticism about AI because I still think we're in, at least, I mean, the way I would think about it is the general public thinks it's just already started. We've had programming, trading going back, at least a couple of decades now. It's just the accessibility of that AI. What people have to realize is the AI does things well on the left side of the brain, which is calculations, analytical thinking to a degree, processing a lot of data. Well, the human being is still the right side of the brain. And so I still think that there's a long way to go to developing the AI in terms of the right side of the brain. Even the left side of the brain of AI, depending on the platform you're using, I've looked at different things where it can't even calculate net present value or internal rate of return all the time. So I think the idea that these tools are foolproof, I have a degree of skepticism. So I'm a little bit of a contrarian, but also we're in still the early stages of this. So the idea that we're going to be able to know when, it's splitting up between probability and uncertainty. So the uncertainty is, the idea is are we going to have a turn? I think about age 13, early 1980s, I saw Arnold Schwarzenegger and the Terminator. So is there going to be an AI event, not that the computer is going to take over, but something happens within the public that sets back AI, so that's a degree of uncertainty, but also the probability of these cash flows across all these companies, that you have the early adopters, but how long is going to take for the cash flows to actually prove profitable with all the capital going in, I think is highly subjective. So that's where I think the markets are valuing perfection, and I think that perfection is going to have a high degree of variability.
Brian, you want to address Faith's question real quick about identity traps? And it sounds like, how do you maintain your discipline when there's volatility and so many things that are worrisome happening in the world?
Well, good investing is really you versus your emotional brain. And good investors put processes in place to make sure their emotional brain doesn't override their long-term rational brain. If you pay close attention to the market, it's very natural for you to want to do exactly the wrong thing at exactly the wrong time. Humans naturally want to buy stocks after they've gone up tremendously, after people are bragging online about how much money they've made from them, and the excitement is really there, which of course is usually the worst possible time to buy into an asset. When's the best time to buy into an asset? After it's gone down tremendously, which is when people are throwing up online, talking about how horrible that asset class is, and when everybody thinks it's dead. You have to ask yourself honestly about your own self. Do you have the wherewithal to resist the temptation to buy after prices have gone up and to move into a market after prices have gone down? For most people, the answer to that question is no. They don't have the wherewithal, which is why the standard advice of dollar cost average into a market fund like an S&P 500 works so well, because there's no thinking involved, there's no timing involved, and you take your emotional brain out of the equation and simply automate it. If you are an individual that is interested in managing your own money and trying to do better than the market, or trying to get a different result than the market would provide, then you do have to spend the time training your brain to do the right thing at the right time, which is very hard to do.
Sticky notes on your monitor can help. My dad still has one on his that says, "Don't chase." So know yourself and put reminders all over the place. We're gonna bring it home and go to segment 3.
Value investing is the institutionalization of rationality. We use everything from deep fake demonstrations to geopolitical insurance analysis to price risk correctly. It's about stewardship, identifying managers capable of maintaining the miracle. Technology can improve efficiency, but it cannot replace the human judgment required to find value when the world is volatile. We are moving from market gamblers to purposeful stewards of our financial outcomes.
Phil, in your opinion, what makes a management team trustworthy enough to steward shareholder capital?
I'll tell you, you can have the view that I had for many years is that I could define that with a management team by looking at their track record, maybe what school they went to, and then I got burned by a really highly qualified management team that just turned into traders on a company. They took it into bankruptcy when it wasn't even remotely near bankrupt. And I got to meet some really good value investors in that bankruptcy court, and we fought that thing like crazy and eventually won. But it was just this nightmare created by a bunch of scheming liars. So identifying a talented management team with integrity is almost something that you do on hindsight. So if I'm looking at a management team, and again, I don't want to bang on Chipotle too much, but when they brought in the former CEO from Taco Bell over to Chipotle, there was a pretty good indication that this CEO was really capable, really able to handle the issues that Chipotle was going through, and it turned out to be the case. And now he's moved on to Starbucks. So sometimes you can get somebody with a really great track record. And I'll tell you, the one thing that I feel really the most comfortable with, Andy, is if the founders are running this business. I feel like they're on the same side of the table as I am. They've got a lot of stock in the company. They are, they're not going to screw the shareholders because they'd be screwing themselves. And I really love to go with founder-led companies. But short of that, I don't think there's a guarantee in the world that this management team isn't going to turn on you.
Brian, what separates an investor from a gambler?
Holding period. That's really what it comes down to. The market can be a giant gambling machine or a giant wealth creation machine. The only difference between those two people, because optically it looks like they're doing the same thing. They're buying and selling securities. The only difference that separates gambling from wealth creation or actual investing is holding period. If you go into the market with the mindset of I'm going to buy this thing today and sell it in an hour, in a day, in a week, or even in a month, to me, that is nothing better than gambling. What you're betting on is that the market re-rates that stock higher due to some factor, news, momentum, or just general bullishness on the overall market. I see no way that I could do that on a reliable, predictable basis. If you're going into the market with an ownership mindset and you're betting on this company or this market is going to generate profits, those profits are going to be reinvested, and that's going to result in compounding cash flows or compounding profits over long periods of time, then you're actually investing and the market is working for you. So to me, the only difference is time horizon.
Victor, how can investors build systems that we can implement to protect ourselves from ourselves?
Well, I think the first goal is to say we want to be Spock from Star Trek. And so if you're doing that, but alongside same way is to say, what are our biases do we suffer from? Do we suffer from overconfidence? Do we trade too much? Are we influenced by short-term information? I would say even myself, in your daily life for good financial health or just good health and overall, have a technology-free zone for a few hours a day. Go outside, turn off your computer, turn off your phone, and be able to clear your head is a good way to starting that system. And then thinking about what type of investor you truly are, but also understanding if you are going to go the value way. There are sometimes a good reason why a company is undervalued. First bucket is it's going to go bankrupt. Second reason is it's just out of favor. But then also the third reason, way to become rich is there's a qualitative piece that is not represented in the current financials of the company. So all that, and then as I said, I'm more of having a diversified portfolio, but also be diversified. If you're not a growth person, or growth investor, at least be diversified enough along your value track. And I think having those systems in place, having those financial goals, using rebalancing, using dollar cost averaging. I love dividend stocks. Again, dividend stocks that are growing their dividends 6 to 8% a year, and then you're reinvesting those dividends, the dividend is doubling. And then so you're getting double compounding. So we're mentality of Wall Street and of us as professionals is we're always looking for the new thing. The old boring things work. You don't have to rediscover the wheel. Everything is there for you. Just keep it simple, and you'll make a lot of money over the long term if you can just take basic investment principles. At least that's what I try to teach my students. As I'm a contrarian because all my students are focused on, their phones, they're trading online, they're gambling on their phones. So I try to desensitize them to do the opposite. Kind of like George Costanza from Seinfeld, do the opposite.
Love that episode. Well, great advice. Keep it simple. One of my favorite themes from this conversation is that successful investing may have less to do with predicting the future and more to do with building systems that protect us from ourselves. So here's one thing to do this week. Take a moment to look at your investments and do a bit of an inventory. Look at your holdings and ask yourself, what part of your investment process is driven by discipline and what part is driven by emotion or noise? Because in markets dominated by AI algorithms and nonstop information, rationality itself may be becoming a competitive advantage. Coming up next, Barry Ritholtz joins us to discuss his new book, How Not to Invest, and the behavioral mistakes that continue to derail investors year after year. But before that, I want to sincerely thank today's panelists for sharing their time, insight, and experience with the Inspired Money community. Phil Town, thank you for helping generations of investors better understand long-term value investing and business quality through Rule Number 1 Investing. You can learn more at rule1investing.com. Brian Feroldi, thank you for making investing approachable, understandable, and less intimidating for everyone. You can follow Brian at brianferoldi.com and across YouTube and social media. Victor Ricciardi, thank you for bringing the behavioral finance perspective and helping us better understand the psychology behind investing decisions and market behavior. You can follow Victor on X at victorricciardi.com. And I think that you will be able to find him at Skidmore in the fall. Inspired Moneymakers, if you enjoyed today's conversation, make sure that you are subscribed. Gentlemen, before we go, is there anything that you want to share, plug, or leave the audience with? Now's a good time.
Yeah, I'll jump in and just say that everything that I heard Andy talk about today in terms of value investing is gospel to me. I think you've really got a really good view of this, Andy, and I appreciate the opportunity to come in here and talk about it. Thank you.
Yeah, if you follow me online, I've been diving deep into AI in particular over the last year and trying to find ways that I can use AI to make the analysis part of investing easier. So if that interests you at all, just on each of my social channels, I'll have links to a product that I'm developing that helps individual investors to use AI to make smarter investing decisions.
As an educator, I'm always just sharing research, so I tend not to give my opinion on X account. I just share things that will help educate you and hopefully help you become a better investor. So my motto is buy low and sell high.
Thank you, gentlemen. Appreciate you. We're going to quickly reset. Our panelists will exit. If you're joining us just now, welcome to Inspired Money. I'm your host, Advisor Andy. We've been exploring whether classic value investing principles still work today. And for part 3 of this program, we're going to shift from markets and valuation models to something more important, human behavior. Because the truth is, most investing mistakes don't come from lack of intelligence. They come from fear, ego, overconfidence, bad assumptions, emotional decision-making, and reacting to noise instead of process. Even highly intelligent people are deeply susceptible to cognitive bias and emotional reasoning. That brings us to today's featured guest, Barry Ritholtz. He is Chairman and Chief Investment Officer of Ritholtz Wealth Management, creator of The Big Picture, host of Bloomberg's Masters in Business podcast, and one of the most respected voices in behavioral finance and long-term investing. His latest book, How Not to Invest: The Ideas, Numbers, and Behaviors That Destroy Wealth and How to Avoid Them, I think just a couple weeks ago, released on paperback. So that's exciting, Barry. What makes this book so compelling is that Barry organizes many of our biggest investing mistakes into 3 categories: bad ideas, bad numbers, and bad behavior. Readers have described this book as more than an investing book, calling it a thoughtful guide to intellectual humility, rational decision-making, in avoiding the psychological traps that quietly sabotage financial success. Barry, welcome to Inspired Money. Great to have you here.
Well, thank you so much for having me, and thank you for that very lovely introduction. I really appreciate it. You know, when you write stuff and put it out into the world, which I've been doing for the past 30 years, you never know if it's going to hit the way you expect, and you nailed exactly what I was trying to accomplish with this book.
Well, thank you. Let's get right into it. We're going to roll segment 1.
We used to let broken businesses fail. Reckless risks carried real consequences. But over time, markets became conditioned to expect government and central bank intervention whenever crises hit. From loan guarantees in the 1970s to the massive bailouts of 2008, the financial safety net expanded dramatically. Critics argue this weakened market discipline, encouraged greater risk-taking, and blurred the line between private reward and public responsibility. When investors believe someone will always step in to stop the pain, risk becomes easier to ignore, and speculation becomes far more dangerous.
Barry, before we get into how not to invest, a nod to your other book, Bailout Nation, where you argue that markets gradually became conditioned to expect government and central bank intervention during crises. Do you think that expectation fundamentally changed investor behavior?
For sure. It certainly changed behaviors of traders and others. Arguably, if you're an investor and by investor 10 plus year time horizon, bailouts aren't really the top of your list. But if we just look at the history of every time a company got into trouble and had a friend in the administration, somehow it always became systemically important. Lockheed bailout in '73 in the midst of the Vietnam War is an obvious example. And then we go through Chrysler in 1980 in a presidential election. And each time, you know, the expression, the camel's nose in the tent, once you let the little bit of the camel in, pretty soon the whole camel comes in. And one of the fascinating data points I discovered while writing and researching this book, which, by the way, was mostly written in real time on the blog, on the Big Picture as things were happening, was if the Treasury Secretary was an industrialist, which very often they were, especially in the early parts of the 20th century, well, banks would be shown the bankruptcy court When they ran into trouble, they weren't bailed out. Hey, that's what those nice buildings with the columns on the downtown, go there. And conversely, when the Treasury Secretary came from finance, came from banking or Wall Street, well, then the industrial side would be shown the bankruptcy court. So just think about, wait, you're going to send Chrysler and GM to bankruptcy, but you're going to bail out Citigroup for the fourth time? You're going to bail out all these big banks like AIG and Bear Stearns and go down the list. Lehman wasn't bailed out because not only had they been engaging in fraud, but they were legitimately insolvent. It wasn't just a liquidity issue. They were worth much less than their liabilities, and hence that's what the bankruptcy court is. So we got one of the many bailouts right, but other than Lehman, everything else was a mistake. And to give the current president a little credit, what he did with Intel, what he's done with some of the quantum computings in exchange to bailouts or funding, taking a big piece, we should have done that with every bank. Anybody that received federal taxpayer money as part of their bailout, the government should have said, we're going to take 40%. The alternative is you go bankrupt, and over the next decade, we will spin it back out to the public. But it should have been a zero-cost situation. Just tear the Band-Aid off and be done with it. Just holding on to these companies and keeping them alive through the grace of the government, hanging on by their fingernails, never a great strategy.
Today we have meme stocks, option speculation, and AI-driven trading all happening simultaneously. Do you think modern markets are more fragile than investors realize?
I don't know if they're certainly faster than they previously were. And, when I was listening to the earlier segment on gambling and the difference between speculation and or gambling versus investing, the big difference from my perspective is when you're buying meme stocks, when you're trading bankrupt companies because they're running up, when all the foolishness we saw certainly during the pandemic, and certainly since trading has essentially become zero cost, doesn't mean it's free, but there's no commission free. People aren't doing it to generate a return on capital ahead of inflation so that they can achieve a financial goal. That's a reasonable definition of financial management. Hey, I have this much capital and I'm going to want to buy a house, pay for my kids' college, or retire one day. So there's the goal. That's investing. The speculation, the gambling, just the outright, meme stock insanity, all of that is done to scratch an emotional itch. It's for fun. It's for dopamine and adrenaline. It has nothing to do with investing, or you could say it has as much to do with investing as a weekend in Las Vegas does. It scratches a completely different itch. It has it's there because you lack emotional discipline and you have psychological needs, and this seems to be one way that you're satisfying them.
Barry, what is one lesson individual investors should take away from decades of bailouts and market rescues when managing their own portfolios?
So there's a good news, bad news. As a citizen, the bad news is, hey, your taxes are funding fundamentally reckless, irresponsible behavior. So as a citizen, I object to bailouts. As an investor, if we learned anything from, go back to 1929 or all of the recessions and depressions and runs on banks and panics that led to the creation of the Federal Reserve, the creation of the FDIC, the 1933 and 34 Securities Acts, is, to paraphrase Churchill, you can rely on the American government to do the right thing after it's exhausted all other possibilities. And so when we end up with a situation, like I recall conversations with clients in January, February '09. And the question was, hey, do you remember, I want to say it was October '08, when the Paulson and Bernanke went to Congress and made their case for a giant bailout fund and to give the Federal Reserve authority to do things that technically they couldn't. So the Senate said, this is outrageous. No, market sold off like 11, 12% that week. And by Friday, the Senate was just a bunch of whimpering cowards who all turned around and says, whatever you need, just make the pain stop. And so the takeaway as an investor is eventually the government will prevent the entire system from collapsing. That's the bet you should make because, hey, if the system collapses, your money is worthless anyway. So you might as well take that bet.
Right. We're encouraged to invest because the world will be saved.
The great Art Cashin used to tell this delightful story when he was a young trader in the early 60s. And this was the height, late 50s, early 60s was the height of the Cold War with Russia. And back then, there wasn't Reg FD. There were a ton of rumors, a lot of people trading on, let's just call it non-public information. And one of the defense company specialists had kind of spread the rumor, hey, get your act together. You got 10 minutes. The Russian ICBMs are on the way over. And Cashin tried to get a short off, and he couldn't get a borrow, for whatever reason, couldn't short the market into the coming Armageddon. And he was telling his mentor and boss afterwards, hey, I really tried to get a short because we heard the Russian nukes were coming. And his boss said, when you hear the Russian nukes are coming, you don't want to be short. You want to be long. Well, why do I want to be long? Well, one of two things happen. Either it's a rumor that proves to be false, in which case the market will rally hard afterwards, or it's not a rumor and nuclear Armageddon comes. What good are your short positions then? So it's very counterintuitive, but that's just how markets work. What is in the price? What is not in the price?
Thank you for the Art Cashin remembrance. Let's go on to segment 2.
Our brains are easily tricked by terrifying context-free headlines. We suffer from denominator blindness, panicking over big absolute numbers without looking at the total picture. When a tech giant cuts thousands of jobs, the media sounds the alarm on a recession. But look closer. A massive layoff might actually represent just 1% of a company's total workforce. This statistical blindness completely distorts how we view investing. Standard models assume markets are steady and predictable, but reality is wildly skewed. The data reveals a stunning truth. A tiny percentage of stocks drive the vast majority of long-term market gains. Capturing those rare long-term winners is extraordinarily difficult, which is why diversification and low-cost indexing remain such powerful investing tools.
Barry, one of the most fascinating concepts in how not to invest is denominator blindness. Why are we so easily manipulated by big, scary numbers without context?
Well, first, pop psychology, evolutionary psychology tells us that for most of human history, and you could go back, modern humans are 200,000 to 400,000 years old, and somewhat human, 6 to 8 million years old, or certainly the nearest relatives. And over 99% of that time history, we weren't really doing a whole lot of arithmetic. We weren't doing statistics or probability. Forget exponential growth. It's just completely separate from how we behave, how we think about things. And so numbers are just completely and totally challenging for us to wrap our head around. I'll give you one of my favorite examples. There was and this is in the book, Outside Magazine published an essay on the epidemic of selfie deaths. When these dumb things first came out, one of everybody's favorite things to do is to take a selfie. And they went over something like over 8 years, there were all these selfie deaths. And by all, I mean about 43 selfie deaths a year. Wow, that sounds like a lot. 43 people kill themselves taking a selfie. The reality is that's a classic case of denominator blindness. All right, 43 is the numerator. Out of how many? That's the key question. Out of how many? So at a Google developer conference in 2014, they said Android users take 93 million selfies every day. 93 million. Now you add in iPhone users, and remember this is 2014 when the cameras were meh. They're spectacular today. So you get, back then it's about 200 million selfies a day. Over that 8-year period that Outside Magazine covered, you're talking about 75 billion selfies a year versus 43 deaths. Like, those are fantastic odds. Your odds are much worse driving down to the supermarket to pick up some milk and eggs relative to, the 40,000 plus automobile deaths a year in the United States. 40,000. We don't really talk too much about that, but 43 selfie deaths are somehow warrant. So that's a classic example of denominator blindness. The other example I use in the book are shark attacks. We're heading into the summer months. There will be a shark sighting somewhere, and the media will love to write about this, cover this. They'll send a cameraman down to the beach, which will be closed. All right, there's 8 billion people in the world, of whom 7.5 billion don't live anywhere near a coastline by an ocean. And, you think about how many shark attacks are there a year? Like 6, 8. And most of those are surfers wearing wetsuits that the shark mistakes for a seal, takes a bite and says, ooh, this is not lunch. This is something else. Very rare to die from a shark attack. The most dangerous animal on the planet, it's not lions, it's not tigers, it's not bears, it's not sharks, it's not orcas. It's mosquitoes, who kill a few million people a year. Dengue, malaria, encephalitis, Nile fever. There are all these diseases that get passed by mosquito from person to person to person. 2 million. Like, when was the last time there was a headline about mosquito deaths? 2 million mosquito deaths a year versus 1, 2. Like, there are years where there are no shark deaths. There will always be shark interactions, shark encounters. For the most part, they're harmless. Occasionally, there will be some mistaken identity, and every now and then there will be a death. But 1 in 8 billion are pretty decent odds against dying from a shark attack. And the same thing applies to investing. We're afraid of market crashes. We're afraid of hyperinflation. We're afraid of all these things that are relatively rare, when we really should be focused on, how do I reduce my costs? How do I stop over trading? How do I make sure, before I'm chasing alpha, how do I make sure I at least am locking in beta? We miss this. It's sharks and terrorism are market crashes and hyperinflation. If you want to live longer, worry less about terror attacks and sharks, and watch your cholesterol, your blood pressure, your sugar intake. Those are the things that slowly undercut your health, and that's what costs over trading, chasing, are the equivalent of. Very counterintuitive, but very understandable.
I appreciate the segue into investing, even though now I'm afraid to go outside.
Why?
Mosquitoes. I'm afraid of the mosquitoes.
There's a ton of safe, effective anti-mosquito sprays that have been developed over the years. Even DEET, which 20 years ago people were terrified of as a cancer agent, turns out to be totally safe. There are a lot of things you can do to avoid ticks and mosquitoes, which is ticks are another big problem, but chemical warfare works.
Oh no, I don't want to talk Lyme disease. You you highlight research showing that a tiny percentage of stocks drive most long-term market returns. I think, was it roughly 1 to 1.5% of
Yeah,
stocks
that's right.
create essentially all net market wealth over time? That's kind of crazy.
It's a shocking set of numbers. Hendrik Bessembinder of Arizona State University kind of stumbled into that research by accident. He was trying to demonstrate what the equity premium was over riskless U.S. Treasuries. And in the process of doing it, not every equity is created equally. So instead of just taking the total market, he started looking at specific individual companies and basically figured out, hey, there's only a handful of things that any stock is going to do. Most go up a little, go down a little, go sideways a while. Some crash and burn, actually more than some crash and burn and go to zero. And what you're left with is just a relatively small handful of names that, if everything else kind of cancels each other out, you're left with a tiny percentage that are driving it. 1 to 2%. It's a little more overseas names. It's a little less in the United States. And certainly since the 1980s, when we kind of stopped doing antitrust enforcement, it became an even more concentrated group. Everybody is obsessed with market concentration, but if you look at how that came about, it's kind of rational. Look at Google, look at Amazon, look at Apple, collect and add Microsoft to that list. They're a combination of 800 acquisitions over the past, throw Amazon in that group also, over the past 25 years. This isn't a concentration in 7 companies. This is a concentration in 700 companies. And when you think of that in those terms, like in the 60s, 50s, you would never have seen Facebook own Instagram, own WhatsApp. You wouldn't see Amazon advertising, Amazon Web Services, all these different things. Google owns search and owns Gmail and all the various stocks. It owns YouTube. Like that sort of stuff. No, you all have to go out and compete in the marketplace. And if you want to know why you're not just markets are so concentrated, but why service is so terrible and prices are relatively high, holding aside inflation, it is the lack of competition that has been taking root. This isn't a political screed. This is just a factual observation. Very, very little antitrust enforcement over the past few decades compared to the previous few decades. And the result is really valuable companies. Again, the dichotomy is, as an investor, I'm thrilled. As a consumer and citizen, I'm somewhat concerned.
Barry, this concentration in companies that are actually having the most impact on performance, how did that change the way that you think about diversification and indexing?
So, in 2 important ways. The first is people are always showing me tables and models and charts and saying, look how it is now, and imagine what it was like relative to the past 50 or 100 years. So it kind of forced me into thinking about that. Hey, is this a fair comparison? Should we be expecting companies to behave in 2026 the way they did in 1926? And I'll give you a perfect example of that. Back in the day, the biggest companies were utilities and railroads and industrial giants. And think about what was required to put those companies together. Yeah, they needed tremendous amounts of capital. They had huge demands for labor and manpower, and giant fixed real estate, factories, fixed cost of goods that just the threshold for cranking out that first car or that first light bulb was enormous. Today, it used to be 2 guys and a laptop and Amazon Web Services. I don't even know if it's that anymore. There was just a data point that came out. There's been Torsten Slok of Apollo. There's been this massive increase in small company creation, but no corresponding increase in hiring. The modern world of technology and AI are allowing all these new startups to come to market with essentially such a tiny initial cost. It's really quite fascinating. So yeah, you have more market concentration today. You have on average a higher PE ratio, but you also have all these intangibles, things like patents and copyrights and business processes and trademarks, which don't really fit into the traditional accounting measure of companies. By the way, Michael Mauboussin of Morgan Stanley's, I forgot the name of the group he's with at MS, has been writing about the value of intangibles, which just aren't reflected in the balance sheet. When you work that out, you end up with, all right, maybe the market isn't as expensive as we kind of think, even though it's a 20-21 PE ratio. So that's really the first issue when you look at market concentration. The second issue is all about those mergers and acquisitions that have been, I don't even want to say tolerated, encouraged, cheered on, so that you end up with, look, we have far fewer airlines than we used to. There's been massive consolidation. The number of banks, it's at one point in time, the biggest 8 banks were responsible for, less than a third of deposits. Now the biggest banks are more than half. So big change over there. This is a significant change. It's really challenging to compare today with 50, 100 years ago, because everything is so different. The focus is different. The involvement of the government is very different. And the technology is different. I'm always shocked when people say to me, why are we so focused and concentrated in technology? And the answer is because that's the future. That's how we're all just go through the history of the American economy, and it is a massive series of technological innovations that were disruptive. And so I think people make a mistake comparing artificial intelligence to the dot-coms. Most of the dot-coms had no revenue, forget profits. These are giant, wildly profitable companies that are completely disrupting the state of the economy. I think the better comparison is the Industrial Revolution, which means if that comparison is correct, AI is going to be affecting everything we do for the rest of the century.
It is very different because these are our biggest technology companies in the world, highly cash flow positive. When investors say, how come so much tech? That's where the earnings and revenue growth is right now. We're going to bring it home and go to the last segment.
The greatest threat to your wealth isn't bad market data. It is the primitive wiring inside your own skull. Our brains were biologically engineered for survival on the ancient savanna, where instant herd behavior kept us alive. When markets plunge, fear and stress often overpower rational decision-making. Investors panic, abandon long-term plans, and sell at exactly the wrong moments, turning temporary volatility into permanent mistakes. To survive, you must establish an automated, objective strategy long before the panic starts. Real market stewards don't try to predict the future or react to scary headlines. They embrace volatility as normal, automate their decisions, and completely insulate their emotions from the noise.
Barry, we've hit the top of the hour. Do you have another 10 minutes to spare?
Sure.
Okay, great. You quote the line, control your amygdala or die poor. What actually happens psychologically when markets crash and fear takes over?
Sure. So stop and think about how humans evolved. For most of history, We are soft, chewy, and delicious. We don't have claws or fangs or armor. So we were frequently lunch. And hence the fear of flight response that we developed as a way to keep us alive. Fight or flight means, not fear of flight, fight or flight means when you're threatened, your blood pressure rises, your breathing rate increases, your heart rate increases. Your body is preparing you to either grab a rock or a spear and fight off whatever's coming, or run and get out of the danger zone. And that was pretty effective. If you had that if you had a fight or flight response, the odds improved of you surviving, and hence why all of us, people who didn't have that response, well, they were unceremoniously removed from the gene pool. So now fast forward into the modern era, which is not what we were built for, and anything that's an existential risk to you, your ability to survive and pass your genes along, will generate that fight or flight response, which comes out of the amygdala in large part. And so what happens when the market drops 10% and the TV is blaring, oh my God, this is the beginning of the next great financial crisis, the next crash? You just want the pain to stop. I love the trader's joke. In the middle of a heavy sell-off, someone says to a fund manager, how you managing this? And he's like, sleeping like a baby. Really? Aren't you concerned about all of this? Yes, of course. I told you I'm sleeping like a baby. I wake up every 2 hours crying, wet myself, and scream for mommy. So that old joke just shows you even the professionals suffer the same sort of emotional responses. The difference is the people who've been doing it for a while and make a career out of it, they kind of learn how to compartmentalize that and use their intellect to say, well, markets drop about 10% at least once a year, down 5% 3 times a year. A 20% drop comes along much more frequently than we realize, about once every 2 or 3 years. In fact, 1 out of every 4 years in market history is negative. So down 20% is not that big a deal in the scheme of things. Hey, if it was easy, if it was never stressful, if there never was a challenge, everybody would be rich. You get paid for suffering through the drawdowns, the pain, the uncertainty, all the stuff that makes buying stocks and holding them for the long term so challenging.
You argue that investors need systems and rules in place before panic hits. What are some practical guardrails that help people to avoid making those emotional mistakes?
So some of it is intellectual and some of it is truly systematic and mechanical. Intellectually, if you understand that these drawdowns are part of normal market operations, that this happens regularly, it's easier to kind of shrug it off. And then secondly, you have to look at the history of the major crashes, which everybody is so afraid of, 87 and 2000. And by the way, if we can include 87, I have to include 97 and 98, and then 2000 and 08, 09, and then the flash crash, and then the pandemic, and then 2022. The history tells us that almost nobody is going to tap out anywhere near the top and then get back in anywhere near the bottom. Because as intellectually attractive as that sounds, we're just not wired to do that. We are herd animals. We exist in a social structure where I'm always reminded of the old Mutual of Omaha. You'd see the savannah and wildebeest and zebra and gazelle. There was always that one animal on the outskirts of the herd, and you just knew that was going to become somebody's lunch. So there's safety in numbers. We like to hide with the group. If you think you could turn around and buy into the market when it's down 57%, as intellectually appealing as that is, emotionally, it's almost impossible. Like, say to yourself, when has buying the U.S. equity market on sale for 50% off ever been a bad trade or a bad investment? Maybe 1929, it took you a few years to get into the green. But other than that, cut in half is a wonderful entry. It is so hard to do because every instinct, all of your emotions, your stomach, everything is saying, God, not only am I going to lose my money if I do this, I'm going to look like an idiot. And so, again, if it was easy, everybody would be rich.
I love the trader sleeping like a baby joke, by the way. Was there a market period that personally tested your own discipline as an investor?
Yeah, and it's kind of ironic because in the mid 90s, when I essentially had no scratch, I had my 401k was, pennies. My wife's 403b was not a lot of money. Every drawdown was agonizing. And the reason for that 30 years ago was every pullback is not just an attack on your investing. What's going to happen if the economy goes in a recession? Am I going to lose my job? If I lose my job, do I lose my health care? Like the stress when you're younger and you haven't seen the movie before. Yeah, you could read about it in history, but it's really different than actually witnessing it on your own. Very stressful. So the irony is when I was younger and didn't have a whole lot of money, every 5% pullback was a big source of stress. The most recent pullbacks, and I can include the flash crash, but really more recently, the pandemic down 34%, 2022 with both stocks and bonds down double digits. I have a lot of money invested. My 401k is 7 figures. I own a firm that's worth, a real lot of money. It's very much tied to what the market is doing. Myself and my 29 equity partners were all employees of the firm. We have most of our net worth tied up in this. And the irony is every time there's a market sell-off with real money at risk, and to say nothing of the $7.6 billion we manage, you kind of shrug it off only because I've seen this movie before. I know how it ends. I know that every time there's a market pullback, it's a buying opportunity. Even if you look at 2000, 2001, 2002. Even if you're early, you're going to eventually get paid back. In fact, I love the data point. If you would have bought the exact top of the dot-coms in March 2000, your equity returns since have been 8.5%. So even the worst timed purchase in recent history generated, if you continue to dollar cost average, it does even better. But just buying that, 25 years later, you've returned 8% a year. That's kind of an astonishing thing. So A, we're really bad at timing it personally, and B, it's so counterintuitive as to what's going to actually the numbers look like over time. But then lastly, just allowing the market to compound and try not to interfere with your portfolio's ability to do that. That's your goal. It's not to pick the next NVIDIA. It's not to tap out at the top and jump right back in at the bottom. Just stay the hell out of your own way, and you'll be so much better off than all of your competitive peers.
We'll leave it there. Try not to interfere and get out of your own way. Let it grow. One of my favorite inspired money moments from this entire conversation is the reminder that successful investing is often less about brilliance and more about avoiding unforced errors, controlling emotions, and building systems that keep us rational when markets become irrational. If you're a tennis player, you know this to be true. And while it may sound simple, it's clear from our conversations today that it's incredibly difficult in practice. So just remember, wealth creation is most about behavior, patience, diversification, and surviving your own emotions. So here's one thing to think about this week before you make your next investment decision. Ask yourself, am I reacting to noise or following a thoughtful long-term process? Because in a world dominated by headlines, AI, algorithms, and nonstop market commentary, rationality itself may be becoming a competitive advantage. You need to build it like a muscle. Practice clear thinking and taking action with a rational mind. If you want to continue learning from Barry, I highly recommend reading his book, How Not to Invest, along with his Masters in Business podcast, The Big Picture, and the work he and his team are doing at Ritholtz Wealth Management. You can find him at ritholtz.com. Barry, before we go, is there anything you'd like to share, plug, or leave with our audience?
So the difference between this book and Bailout Nation is kind of a screed that's deeply researched and filled with a lot of tedious historical data about the Fed and bailouts, and it's really kind of an academic book. This book was just so much fun to write, so much fun to discuss all these amazing mistakes that people make, not just you and I, but billionaires and professionals and people you would think would know better. It was just great assembling many of my favorite anecdotes and stories from outside of the world of finance to show how they apply to investing. And that's everybody from the Beatles to John Wick to Squid Games. There are lessons to be learned, starting with we all need to be a little more humble, have a little more humility. Nobody knows anything. Nobody knows what the future brings. And when we build portfolios on the assumption that we know what's going to happen, bad things tend to occur. We definitely have to be a little more probabilistic and a little less binary, to use the mathy terms.
Thank you, Barry. Humility and that overconfidence, that's when you tend to get a serving of humble pie. So be careful out there. Inspired Moneymakers, thank you for spending this time with us. I believe that it was time well spent. I hope that you do too. If you enjoyed this episode, please like, subscribe, share this conversation, and leave a comment with your biggest investing takeaway from today's show. Make sure that you subscribe to us, Inspired Money, on YouTube. A special thank you to the Inspired Money team, Bradley John Eaglefeather and Chad Lawrence, for helping produce today's show and making conversations like this possible. And Inspired Moneymakers, let's stay connected. You can find me on LinkedIn. Just search for Advisor Andy. This is Inspired Money. Until next time, do something that scares you, because that's where the magic happens. Thanks, everybody.